Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. Now, on this show, we sift through the entire market and find perfect investment products for you, depending on what your goals are, which means you need to write to us. Our email ID is at the bottom of your screen. Send in any question you might have about saving, spending, or investing. We'd love to answer your questions on this show. This week, we'll also take a look at education loans. We'll tell you everything you need to know about applying for a loan right now. In our product review, we look at the Birla Sun Life Mid Cap Fund. We'll tell you what last-minute tax investments you can make for this year that will also give you good returns. Well, let me bring in Kumar, the CEO of Value Research. Thank you so much for joining us.
Thank you.
Let's get straight to our portfolio question. Our first question comes in from Ashish, who writes in, he's 41 years old and he has a goal to create a corpus of 2 crore rupees for both of his sons' education and marriage. He tells us his oldest son is 14 years old and the younger one is only 8. Now, let's take a look first at his insurance. He has a term cover of 1.4 crore rupees. He pays an annual premium of about 40,000 rupees for that. He invests 10,000 every year in the Jeevan Suraksha plan from LIC and 8,000 every year in a children's money back plan. He also has about 30,000 rupees a year going into his mutual fund investments. We're going to get to the specific funds in a little while. The bulk of his investment really, Dhirendra, is in his PPF and his company PF, which is about 20 lakhs and 16 lakh rupees right now. Now, his contribution to his mutual fund is not adequate to reach his goal. Would you suggest that he looks at his PF as well when he's considering his son's education? Should he be open to maybe breaking those investments?
Yes, I think it's very important for him to, take that step immediately, because it looks like, he has historically accumulated all his savings into the PPF and the Employee Provident Fund. Employee Provident Fund may not be negotiable in terms of, the deduction which is from his salary going into Company Provident Fund. He can't do much about it, except that it will be accessible or part withdrawal might be possible. But PPF is a completely discretionary thing. The first thing he should do is, he should discontinue his PPF contribution. Maybe he should retain his, current accumulation. But his incremental savings, at least to the tune of 1 lakh rupees, can well go into the tax saving fund. And the other thing is that, if he's accumulating, if his contribution or a defined contribution is targeted towards his child's education 10 years from now, I think he should look at it a little differently. He should be prepared to, take the money back from his Company Provident Fund and the PPF 10 years from now. And he should look at the equity fund where he's investing, which, for his retirement, for next, for a longer period, 20 years time frame. That is something which he should think in terms of his retirement corpus.
All right, so Dhirendra, let's take a look at his mutual fund investments for now. He has a total of 30,000 rupees going into these funds. He has the Franklin US Opportunities, HDFC Mid Cap Opportunities, ICICI Prudential US Blue Chip Equity, ICICI Prudential Focus Blue Chip Equity, IDFC Premier Equity, Reliance Equity Opportunities and UTI Opportunities. He's obviously picked these funds very carefully, a lot of them based on your recommendation. Now, given the chart that you've drawn out for him for the next 10 years, do these funds fit the bill?
Yeah, I think he has an excellent portfolio. And, 1 or 2 steps which he has taken, which is discontinuing the Reliance Equity Opportunity, substituting it with HDFC Mid Cap Opportunity, is also a good step, in terms of, a superior selection. So he should just be conscious that he should not be liable for any short-term capital gains, which is investment made within last 12 months.
All right. So remember, Dhirendra, they're telling you that you should be reviewing your portfolio every year or so. And if you have any more questions about making investments and reaching that goal of 2 crore rupees, feel free to write back to us on the email ID that's at the bottom of your screen. Let's take another question, Dhirendra. This one comes in from Vishnu, who's written in saying that he's a first-time investor. He wants to begin investing in equity. So far, his only investment is a recurring deposit. Now, he's written in saying that he might consider investing in stocks. He's looking at how the stocks of Axis Bank, SBI and Yes Bank are doing right now. I would personally completely dissuade him from doing that because he's a first-time investor. Would you give him some advice on how you'd like him to get started on an equity fund, perhaps?
This is a very disastrous way of approaching investment, that he thinks that he's anticipating that bank results will be bad and he will be getting an opportunity to buy some of these banks cheap. But he should look at investments. exactly, he should approach his investment exactly like his recurring deposit. If he can save 5,000 rupee or more, or 4,000 rupees more, he should choose one good fund and carry on with that. And he should have this fund allocation, this 25,000, 50,000 rupee, try his hand and do an objective review with his investment vis-a-vis the SIP or the mutual fund which he'll be doing.
Virendra, that was the fun allocation that you recommended for his money. Let's talk about the serious allocation. So far only has one recurring deposit going in. Would you like him to perhaps start with one equity mutual fund, and could you give him a fund that he can use?
Yeah, I would suggest, ideally when there's the first time investor, I normally suggest him to go for a balanced fund. But in his case, because he's already carrying a recurring deposit and he's willing to assume risk with his equity, so I would say that, he can be a little venturesome. I would suggest him, funds from our growth portfolio, the large and mid cap fund.
All right, so funds from our growth portfolio are on your screen right now. And if you have any more questions, feel free to write to us. Our email ID is at the bottom of your screen. So before we go into break, we're getting a lot of questions now from young people who are taking their entrances to get into engineering, medical or management colleges. Now, for those of you who are looking to process a student loan over the next month or so, we've put together a guide of all of the documents that you'll need and, of course, all the interest rates available in the market right now. Take a look.
You are part of a young new generation of Indians who are ready to take the world on. And if your ambition fuels you to conquer new territory, don't let money stand in the way. Indian banks now have several strong student loan programs designed to help you achieve your full potential. The process is fairly simple. To begin with, you need guarantors with a regular source of income.
As I said, up to 4 lakhs under the IBA education loan scheme, collateral is not, the banks are not supposed to insist on a collateral for loans up to rupees 4 lakhs. Above 4 lakhs and up to 7.5 lakhs, the banks typically will settle for a guarantee from somebody with a regular income. Above 7.5 lakhs, apart from the guarantee, the bank would insist on a collateral.
The most common forms of collateral that we've seen at bankbazaar.com when people apply is home, flat, land, fixed deposit. There are certain lenders who also accept things like government bonds.
The good thing about student loans is the prepayment period will only begin after you finish your course and find a job, although the loan begins accruing interest from day one.
You are expected to start repaying the loan, okay, within 1 year from the end of the course or within 6 months of starting a job, whichever is earlier. Till then you need not pay anything. Even in fact the interest can be accumulated. You need not pay it.
Here's a quick look at the interest rates banks are offering on education loans as of today. The rates on a loan above 7.5 lakh rupees vary anywhere from a minimum of 12.25% to a maximum of 16.25%. Certain PSU banks offer a discount of 0.5% on interest rates on loans to girls, and girls from scheduled castes and tribes get a discount of 1% on their loan rates. So now if you are applying for an overseas course, it is important for you to deal with your visa as soon as you can, as most universities require a confirmed admission and a proof of funding for the course you want to do before they hand you a visa. But the biggest worry for you is the currency risk.
The moment you get a job overseas and your income is in dollars, and now if rupee depreciates, now you get a benefit because your loan is been fixed in rupees. And therefore and if the dollar value, for example, appreciates, then you're getting more rupees for the same dollar, and therefore you will have a ability to pay off the loan much faster.
Student loans cover travel to place of study, living expenses, books and equipment. So make a good estimate of how much money you will need through the length of your course.
Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. It's time for our product review, and this week we're looking at the Birla Sun Life Mid Cap Fund. Avan is here to give us a quick introduction into this fund. Avan.
Thanks for that, Faye. Well, the fund under scrutiny this week is the Birla Sun Life Mid Cap Fund. The fund has been around for 12 years now, but most of those 12 years were spent at the bottom of the leaderboard. Although the fund was launched in October 2002, it didn't really perform until 2006. In the downturn of 2008, the fund manager took refuge in debt and cash, and in 2009, the fund delivered admirably with a return of 120%. But it slipped from its position in 2010 and hasn't recovered since then. The fund's performance over the last 3 years has been disappointing. Over the last year, the fund has lost 4.5%, while its category average is up 1.5%. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund, you would have 1,164 rupees today. So should this fund be a part of your portfolio, or should you pull your money out? Our experts are here to give you the answer. With that, it's back to you, Faye.
Alright, Avan, thank you so much for that introduction. Dhirendra, Birla Sun Life Mid Cap, the last time we reviewed it in April 2012, you gave it 3 stars. It's fallen a little further on your website. It's currently rated as 2 stars. So I want to understand from you, for viewers who are holding this fund right now, would you recommend that they quickly start getting out of that fund?
Yeah, I think so, because this fund has been very disappointing in the last 4 years, and disappointing despite generating good return. If you look at this, this fund, despite the fund doing well, there are many other funds which are doing much better. In fact, most other mid and small cap funds are doing better than this. So this fund has not been able to get its momentum back in the last 4 years, and its best time was its initial 4-5 years when it did very well, and possibly a well-timed launch, a bull run, followed by the biggest gains we have seen on the mid and small cap stocks during that phase, 2004 to 2007. It has been a witness to that. Of course, we haven't seen a repeat of that, but most other funds have done much better in the last 4 years, while this fund has struggled.
Well, Dhirendra, for those viewers who you just instructed to leave the Birla Sun Life Mid Cap Fund, I'm going to call out the 3 funds you picked out for the year, which is the BNP Paribas Mid Cap, HDFC Mid Cap Opportunities, and SBI Magnum Emerging Business. That's on your screen right now. Should they be now, looking at gradually pulling out and moving into one of these funds, or should it be, all in one shot? How would you recommend they make that change?
Just be conscious of your own exit load as well as the short-term capital gains, and you can move to one of these funds. These are superior performing funds, and you can move all your money at one go. Just be conscious of that exit load and the short-term capital gains liability. Normally, when we say a STP or a SIP, the idea is that you are not catching a market peak, but here your money is invested in equity, and you are carrying a portfolio anywhere. You are exposed to that market risk. Moving that money at one go isn't a problem.
Alright, so moving the money at one go isn't a problem. Those funds are on your screen one more time. This is Dhirendra's pick of mid and small cap funds for the year 2014. Dhirendra, finally, your rating of the Birla Sun Life Mid Cap Fund, where would you place it?
If we look at it, at this fund in isolation, it doesn't look disappointing. Last 5 years it has given a return of 20%. Only when we look at other options available, it looks disappointing. So yes, it's not the finest choice. A 2 star.
2 stars there for the Birla Sun Life Mid Cap Fund on Investor's Guide. Let's move on now to our hold or sell segment. Shailesh writes in, Dhirendra, he's 31 years old. He's been investing in equity for the last 1 year, a time horizon of 20 years. He wants to know if his portfolio is on track. That's a total of 18,000 rupees going into his portfolio every month. I'm going to club the first 4 funds together because they're similar. He has the ICICI Prudential Focus Blue Chip. He has the Franklin India Blue Chip Fund. Then he has HDFC Top 200 and the DSP BlackRock Top 100 Equity Fund. Of the 4 funds, Dhirendra, let's take Prudential Blue Chip and Franklin India Blue Chip together. Does he need both of these funds in his portfolio, especially with a 20-year horizon?
If you want to carry a portfolio which requires less maintenance, less maintenance is very useful, because you don't have to worry about the taxation issues, you don't have to worry about the you don't have to actively monitor it, and from that point of view, I would say that you can keep away from something which is extreme, which is defined large cap. If you are, and from that standpoint, you have 3 such funds: Franklin Blue Chip, DSP BlackRock Top 100, as well as Franklin ICICI Prudential Frontline Blue Chip, they will all be large cap and they will always be large cap. So I would say that consider funds which are more flexible. They invest in large cap, mid cap, small cap. In your next 20 years, you will have various phases of the market. There will be a phase of and there will be a phase of market when mid and small caps will beat large caps by a handsome margin, and by a margin which is unthinkable. And that is what typically happens. That is what happened in 2004 to 2007, and there will definitely be a repeat of that in next 20 years.
Well, Dhirendra, you didn't mention the HDFC Top 200 fund that he's holding. Would you recommend he continues holding that fund?
Today, it looks to be a large cap tilted fund, and possibly it will remain one because the fund has turned very big. So it is unlikely to be having a very large component of mid and small cap, or those positions will not have a meaningful impact on the fund's portfolio. So I would say that from that standpoint, HDFC Top 200 will also be a constrained portfolio on focused on large caps.
Well, the next fund in his list, Dhirendra, is the ICICI Prudential Discovery Fund. 3,000 rupees going into this fund every month. Now, I know this is a fund that you recommend on the show, but would you like him to increase his allocation to this fund in any way?
Yeah, I think so. And for it is a value fund, and it has done exceedingly well on a 5-year holding period. For his kind of time frame, if he can withstand the declining phase of the market, this is a fund which looks very promising over the next 5-7 years if the depressed market prevails.
All right, I'm going to take the last two funds together, UTI Dividend Yield and IDFC Premier Equity Plan. Dhirendra, continue both of these funds?
They make a very nice portfolio. And also, given his time frame and his ability to withstand, there could be some meaningful addition to this portfolio, and maybe he should consider large and mid cap fund or a multi cap fund from our growth portfolio or our aggressive growth portfolio, one or two fund to substitute the large caps just in case he's substituting them.
All right, on your screen right now are the large and mid cap funds from our growth portfolio that you could add to the portfolio that you're holding right now. Dhirendra, they're telling you to hold on to the last 3 funds on your portfolio. Write back to us if you have any more questions. Let's take a couple of more questions. Vikas Verma has written in, Dhirendra. He wants to know if there are any equity mutual funds that have weekly SIPs. My question to you, Dhirendra, is that for anybody watching right now, does it make sense really to do a weekly SIP or a monthly SIP? What's the best way to go about that?
Monthly SIP works nicely with our earning cycle. We get our salaries every month, or we pay our EMIs every month. But doing too much of a good thing may not necessarily be very good. In which way? Sometimes weekly SIP numbers might look a little better, or sometimes the monthly SIP numbers might look a little better. I think regular investing is all about managing your own anxiety, and weekly is unlikely to make any huge difference.
All right, so weekly SIPs are unlikely to make any huge difference, even though you are allowed to start weekly SIPs across most mutual funds. All right, Dhirendra, thank you so much for joining us this week and answering all of our questions. We look forward to sitting down with you again next week. Welcome back. You're watching Investors Guide in ET Now. We've brought in Gaurav Mashruwala to answer all of your investment questions. Gaurav, thank you for joining us.
Thank you.
Ankit Mehta writes in, he has his monthly take-home of about 50,000 rupees and he pays an annual premium of 34,000 rupees on his family's health cover. He has 30,000 rupees going in as an LIC premium every year, and he also has a term cover of 85 lakhs. He wants to invest now to save on tax for the year, obviously, and to get good returns. He wants to know if the PPF makes sense right now, or should he be using a ULIP? Gaurav, what would you recommend?
Ankit, a lot of information, some distorted, some useful, but here are a couple of basic points. Number one, always keep in mind your financial goals and then do savings. So you have mentioned financial goals, and I will talk about the savings and investment that you can do to achieve those goals. Firstly, health insurance. A premium paid up to 15,000 for your own life and your family member, for your own health and for your family members, is tax deductible. And if you're paying for your parents who are senior citizens, you get 20,000. If they're not senior citizens, it's 15,000. So one is a tax saving that you can do that. Paying for your brother and other members of your family, brother, sister, sister-in-law, you may not get tax benefit, but you may want to verify that with a chartered accountant. Number one. Number two, you have spoken about various insurance policies and companies, but I would not comment on specific schemes. What is important to keep in mind is never use life insurance from investment perspective. Life insurance is only to cover the risk of death. You already have a term plan. If you feel there is need for more life insurance cover based on your responsibilities and all, then you may want to buy additional term cover. Apart from that, you have stated that you don't require money for 5 years and you want to save tax. Now, if 5 years is what your time horizon is, then there are two options within Section 80C. One is National Savings Certificate. It used to be originally 6 years, but now we have two variants, 5 and 10 years. And we have bank fixed deposits which qualify for Section 80C, and that's why there is 5 years tenure available. Number one. For your long-term goal of creating retirement corpus or anything else, as far as equity is concerned, there are two options. One is equity linked savings scheme. While lock-in there is 3 years, but it's an investment into an equity as an asset class, and hence you may want to do SIP into a good performing equity linked savings scheme.
Our next question comes in from Joseph. He tells us that he gets interest of up to 10,000 rupees a year from his savings account and his fixed deposits. He wants to know if he should be investing that money, Gaurav. Obviously, he has to pay tax on that money, but over and above that, what would you like him to do?
Joseph, you can certainly save this money. It's an income that's coming to you. One thing you have to keep in mind is, depending on the tax bracket you are in, you may have tax implications on these, but that you need to check with the chartered accountant. Apart from that, this money can be used based on your financial goals. You can do a recurring deposit in a bank since money is lying in the bank, or you can go and do a systematic investment plan into a mutual fund. If your goals are near term, say 2 to 3 years, you can do a SIP into a debt-based mutual fund scheme. If your goals are 7 to 9 years away, you can do an equity mutual fund scheme. For an interim period, you can make combinations. So you have option of doing recurring deposit in bank, recurring deposit in post office, SIP in debt fund, SIP in equity fund. You can even do a SIP in gold fund. So there are many options available with this income that you have. Since this income is more or less certain, you'll be able to plan much better.
Last question on the show. Wangsu writes in from Arunachal Pradesh. He wants to know how much he should invest right now to create a corpus of 10 lakh rupees in 3 years. And also he wants to create a corpus of 3 crore rupees in 25 years for his retirement. So obviously, Gaurav, he's going to be investing on a regular basis in a monthly SIP format. What should he be putting away right now, and how would you like him to invest that money?
One is, let's look at your first goal, which is going to come up in 3 years' time, where you want about 10 lakhs. If you want 10 lakhs in 3 years, what you will have to do is choose a debt-based instrument, typically earning about 8 to 9%. So it could be a debt mutual fund, or unless some bank is offering a recurring deposit. And you have to set aside roughly about 25,000 per month to reach that number of 10 lakhs in 3 years. That's number one. If you find that number large, then either increase the time horizon or reduce your expectations. Don't take aggressive risk, because then your chances of losing money and in 3 years' time recovering could be a little difficult. For your second goal, which is retirement 25 years away, I would recommend equity as an asset class. You can do an SIP into an equity-based mutual fund. Start saving about 11 to 12,000. I'm assuming 14% annualized returns over a period of 25 years. So you may have some years which are bad, some years which are good, but to assume 14% annualized returns over a period of about 25 years is safe. And do an SIP into an equity mutual fund. Now, if you have skills and time, you can look at a large cap actively managed fund. If you don't have that, then look for an index fund.
All right, Gaurav, thank you so much for answering our questions on the show this week. If you have a question for any of our experts about anything to do with your money, write to us. Email ID is at the bottom of your screen. It'll be our pleasure to answer your questions on the show. Remember, you'll find copies of our show on our Facebook page, and you can reach me personally on Twitter. I look forward to hearing from you. Thanks so much for watching.